Joining us now is the Vice Chair of Equity Capital Markets and the Head of West Coast Tech Banking at Jefferies, Cully Davis. Cully, thanks so much for joining us today. So those who believe the market is toppy look at the IPO performance for some of these recent tech deals and say, this is the poster child for kind of bubble-licious signs out there. Do you believe that there's enough investor demand to pay up and pay decent multiples for these deals that are coming down the pike in the second half of the year?
Sure. Hey, Leslie. I do. These are the kind of years that tech investors wait for. We've had the benefit of a large number of highly anticipated companies come to market. Many have already come. A lot are to come still this fall. And investors, they chase what's working. And tech is the best performing sector so far this year. So despite the fact that multiples are high, particularly software multiples, we're seeing historic highs, all-time highs for some of these recent software IPOs. But in general, investors do chase what works, and tech is working right now. And a lot of these names are very, very well-known names.
How does the recent volatility play a role here? Because historically, and kind of the ingredients for a successful IPO market would include low volatility. Are you having conversations with boards of prospective companies that are looking to go public? And how are they kind of thinking about the recent activity as they look forward to their IPOs?
Sure. Yeah, volatility is not the friend of the IPO. You generally want markets that are calm, that are easy to anticipate. Investors like to use those calmer markets to try and value companies that have, at this point, have no kind of public history. So volatility is generally not a friend of the IPO market. I would argue, even though volatility is increased right now, it's not at levels where we shut down the IPO markets for sure. Trading desks love the volatility. Trading desks, thrive on volatility, and when we have a quiet market, we're right in the middle of kind of a holiday season right now for the market. So I think people are kind of waiting and standby, waiting to see how things look come post-Labor Day, when all the traders are back in their seats. Again, volatility doesn't help the markets necessarily, but we're not at levels that shut it down by any stretch.
At the same time, you've seen kind of this bifurcation on performance in terms of tech companies going public. On one hand, you have the Zooms of the world, the CrowdStrikes, Beyond Meat, if you could call that a tech company, Pinterest, and so forth. They're doing incredibly well. And then on the other hand, you have names like Uber, Lyft, Jumia. Are there any lessons that these companies and investors can kind of take away from the companies that have performed well in the first half of the year that might indicate successful performance in the second half of the year? And then also any lessons they can take away from those that haven't done as well and have kind of turned off investors that might indicate some weaker performance for certain types of companies in the second half of the year?
Sure. Yeah, we have seen a little bit of a barbell. Well, on average, tech IPOs are certainly up and trending above the general indices. There are a handful that have traded really, really well. The names you mentioned, like Zoom and CrowdStrike and some of the software companies, and ones that have struggled. I think if you look at the kind of business models that have done the best, software always is a very active tech sector. And software business models are very well understood by investors. And you'll see companies that have really, really large market opportunities spending a lot of money to capture market share. Those types of companies, if they're a software business, investors just have a lot of confidence that the kind of steady state model is one that actually drives profitability and has lanes of kind of margin output that they can count on. So you'll see software companies generally get bid up quite a bit because they are safe havens and they're business models that are very, very well understood. The ride-sharing names like Lyft and Uber are obviously spending a tremendous amount of money to drive market share, to really build their business. But those business models are not yet really understood or proven. They're really new business models. And so companies like that, while they're amazing companies, have the burden of having to kind of prove out the model and really don't have a historical context for investors to rely on. So they've struggled a little bit more in this kind of environment.
All right, Cully, it'll be interesting to see if WeWork is seen as more of a proven model, despite the fact that it has such sizable losses as it launches its debut as soon as next month. Cully Davis, thank you so much for joining us.